Understanding financial statements is one of the most important life skills anyone can develop, whether you're running a business, investing in stocks, or simply wanting to manage your personal finances more effectively. Yet for many people, the world of finance can seem intimidating, full of confusing jargon, columns of numbers, and unfamiliar terms. But the truth is, with a little guidance, anyone can learn to read and interpret the basics. And once you do, you'll find yourself empowered to make smarter, more confident decisions about your money and future. Imagine sitting down at a table, a company's annual report spread out in front of you. The pages are filled with information, but among these, 3 key financial statements stand out: the balance sheet, the income statement, and the cash flow statement. Each one tells a different part of the company's story, and together, they offer a clear window into its financial health. Let's start with the balance sheet. This is a snapshot, capturing a company's financial position at a single point in time. Think of it as a photograph taken the last day of the fiscal year. On one side of the balance sheet are the assets, everything the company owns. On the other side are the liabilities, everything the company owes. The difference between these two is called equity, which represents the value that belongs to the owners or shareholders. Imagine, for instance, a local bakery. Its assets include cash in the register, flour and sugar in the pantry, the ovens and mixers, and even the building if the bakery owns it. Its liabilities might include loans taken to buy equipment, unpaid bills to suppliers, or wages owed to staff. The equity is what's left over for the owners after all the debts are paid. By scanning a company's balance sheet, you get a sense of its stability. Does it have enough assets to cover its debts? Is the equity growing year after year? If liabilities are piling up faster than assets, that's a red flag worth investigating. Next, turn to the income statement, sometimes called the profit and loss statement. This is where you see the company's performance over a period of time, usually a quarter or a year. At the top, you'll find revenues, the total amount of money the company brought in from selling products or services. Subtract from this the costs of doing business, such as buying ingredients, paying staff, and running advertisements, and you're left with profits, also known as net income. But profits aren't just a simple number. It's important to look at how the company is making money. Are sales growing year after year? Are expenses being kept under control? Is the profit margin, profits divided by revenues, healthy, or is it shrinking? A company can have large revenues but still struggle if costs outpace income. By tracking these indicators, you gain insight into whether a business model is sustainable, whether the company is adapting to challenges, and whether it's likely to reward investors in the long run. Then there's the cash flow statement, perhaps the most overlooked but critical of all. While the income statement shows how much money was earned on paper, the cash flow statement reveals how much cash actually moved into and out of the business. This matters because a company can show profits on its books, but still run out of cash. If, for example, customers are slow to pay their bills, or if big investments tie up available funds. The cash flow statement is divided into 3 sections. The first is operating activities, which shows the cash generated or used in the core business, making and selling goods or services. The second is investing activities, such as buying new equipment or selling off old assets. The third is financing activities, like taking out loans or paying dividends to shareholders. Positive cash flow from operating activities is a sign of a healthy business. It means the company's day-to-day operations are bringing in more cash than they consume. Negative cash flow here could signal trouble, especially if it's a recurring pattern. Investing activities tell you whether the company is expanding or scaling back, while financing activities reveal how it manages debt and rewards investors. Let's bring these concepts together with a simple example. Suppose you're considering investing in a small technology startup. You look at the balance sheet and see that the company has more assets than liabilities, a good sign. The income statement shows growing revenues, but profits are slim because the company is investing heavily in research and development. On the cash flow statement, you notice that cash from operations is positive, but cash from investing activities is negative. reflecting all that investment in new technology. What does this tell you? The company is on solid ground, growing its sales and investing for the future. The modest profits aren't a concern as long as the business keeps generating cash from its core activities. You dig a little deeper, comparing the company's current liabilities, debts due within a year, to its current assets, like cash and receivables. This ratio, known as the current ratio, helps you judge whether the company can meet its short-term obligations. A ratio above 1 is generally safe. Below 1 could mean trouble. Armed with these basic tools, you can now approach any company's financial statements with greater confidence. You know to look beyond the headlines, beyond just net profit or total assets, and dig into the details. You ask smart questions. Is profit growth coming from real sales or just accounting tricks? Is the company juggling too much debt? Are cash flows strong, or is the business struggling to collect payments? Understanding financial statements isn't just about numbers. It's about seeing the real story behind them. Each figure represents decisions made, risks taken, and the everyday realities of running a business. The bakery owner choosing whether to buy a new oven, the startup founder deciding how much to invest in product development, the retail manager managing inventory and payroll. These are the stories hidden in the balance sheet, the income statement, and the cash flow statement. As you develop your financial literacy, remember that no single indicator tells the whole story. Profits matter, but so does cash flow. Liabilities are a concern, but only in relation to assets. Trends are just as important as snapshots. By building your understanding step by step, you'll not only make wiser investment decisions, you'll gain the confidence to take charge of your own financial journey. In the end, financial statements aren't just for accountants or investors. They're for anyone who wants to make informed, effective decisions about their money, their business, or their future. And with each statement you read, each indicator you interpret, you're building a vital life skill, one that will serve you well for years to come.